Hello everybody, it's Ed Ponsi from edponsi.com. Welcome back. Thank you so much for all the great feedback you're giving us. We have the free education center all set up, and I know a lot of you are in there having a good time looking at all that great information. If you're not in our free education center, just send an email to info@edponsi.com. That's edponsi.com, and we'll get you taken care of. We'll get you your login for the free education center. We're also having a webinar, another one on February 12th, 2 p.m. Eastern Time. I hope you'll be there. We've had great attendance, great feedback. A lot of you folks are signing up for our courses. We very much appreciate it. We're getting great feedback from you. Thank you, thank you, thank you so much. I really appreciate it. Okay, let's talk about the markets for just a second here, because it's been a wild day. First, we had the new head of the Bank of England. I should say he's not the head of the Bank of England yet. Mark Carney speaking in England for the first time. And it was wild, right? The British pound shot up 90 pips in about 10 minutes on a total misunderstanding. To me, that's free money. You got to keep your eyes open for stuff like that, okay? Carney said that he needs an exit strategy from the easy money policies that England has been in for several years. The only problem is, it's the dead of winter right now. Carney's not taking over till summertime. Hello? A little premature there on that 90 pip pop. It went right back down over the next few hours. They're giving money away when they make mistakes like that. Honestly, you got to take advantage. Also, today, we had out of Europe, Draghi, and a really wild move in the euro today on a speech by Draghi, where he basically questioned the exchange rate of the euro. He was asked a lot of questions about, is it too high? Is the euro too strong? Is it hurting business? The truth is, Draghi wasn't that dovish, but the market sort of just flipped out. It gives me the impression that somebody out there wanted to sell a lot of euros, and they were going to sell it no matter what Draghi said, okay? You could say that's the catalyst, but it might not be the full reason. Who knows? Who out there has a lot of euros that they might want to get rid of? I could think of the Swiss National Bank for one thing, just speculating here. Okay, but there might be a lot of people who are in that position now. The euro's going up a great deal. I'm just saying at this point, even if it falls to support, if it gets there too quickly, don't be in too much of a hurry to get in. Don't just pay attention to the price. Pay attention to the velocity. Don't just tell me how much it costs. Tell me how it got there. There's a very big difference between something floating down like a feather down to support, as opposed to like the space shuttle coming in on re-entry into the Earth's atmosphere, okay? There's a big, big difference. If something is falling too hard, too fast, we have a saying in this business, you don't catch a falling knife, all right? So you let things stabilize before you get in, if you get in at all. Now, I know what some of you are thinking. There goes Ed talking about currencies again, right? And yes, I do have a lot of followers who are into trading currencies, and there's nothing wrong with that. But if you're just trading the stock market, you'd better be aware of this too. Because the euro coming down totally took the S&P 500 and the Dow down with it today. Those correlations still exist. They're not as strong as they used to be. Remember, it used to be just one big trade back in 2012. You know, if the euro was going up, then almost certainly the stock market was going up and gold was going up, and vice versa. They would all go down together. That's not as true now. Some of these correlations are weaker now than they were before. But I just want to point something out. They're weaker on the way up. When people are feeling more comfortable and they're embracing risk, money's just kind of going to all these different places, and they're not necessarily going at the same pace. But when they're scared, money is rushing basically back to where? Back to the dollar, back to US Treasuries. And that means the correlation is stronger on the way down because it's kind of a one-way trade on the way down. On the way up, everything's dispersing. And therefore the correlations are going to be weaker. So here's the thing, right? Are the correlations in 2013 going to be as strong as they were last year? I'd say probably not. I'm a little more bullish on the stock market this year, and I think we've already seen that after a great January the correlations did weaken. But on those down days, you're going to see those correlations get stronger again. Something to keep in mind, because if you've been living on these correlations for the past few years, you got to adapt when the market changes, and that's what the good ones always do. The really great traders are the ones who see the change coming and adapt to it instead of just hammering the same thing that worked last year, and even long after it no longer works anymore, these poor guys are still banging away at the same thing, hoping it starts working again. The market always changes, and the ones who notice it first and adjust first are the winners.